Welcome back to Library Trader by Option Arcade. Today, we're diving into Trading in the Zone by Mark Douglas, one of the most powerful books ever written on trading psychology. If you've ever struggled with discipline, consistency, or managing emotions in the market, this one's for you. Let's get straight into it.
Welcome to the deep dive. We take your sources, pull out the key insights, and help you get informed fast. Today we're digging into something really fascinating. Why do so many smart, successful people, doctors, lawyers, engineers, why do they often struggle with trading, even when they've got all the analysis tools?
Right. The common idea is, I just need a better system, more data.
Here, more information.
But what our sources suggest and what we're exploring today is that the real key isn't out there in the market. It's inside the trader's head.
Inside the mind. Okay.
Exactly. Our mission here is to unpack the psychological principles that make the difference between consistent winners and, everyone else. We're drawing heavily on material that focuses on that internal mental game. By the end, you should have a much clearer picture of what thinking like a trader actually means.
Okay, so let's start there. Trading history shows this shift, right? From fundamental analysis, trying to figure out supply, demand, all that.
All the company reports, economic data.
To technical analysis, looking at charts, patterns, price action. And that shift happened because fundamentals were just really hard to consistently profit from because, people drive prices and people aren't always rational.
Not even close sometimes.
So, okay, technical analysis seems more direct, maybe more effective at spotting opportunities. But then why is there still this psychological gap? People know the patterns, but they still don't make consistent money.
That's the core question.
And the sources point out something striking. Some of the biggest failures in trading are these incredibly accomplished people from other fields. Even top market analysts sometimes make terrible traders. What's going on there? What are they bringing from, say, being a great doctor that messes them up in the market?
It's fascinating, isn't it? Because it shows that raw intelligence or analytical skill, that's not the deciding factor.
Okay.
The real difference is how the successful traders think. It's a specific mindset, a unique set of attitudes, and trading is just full of these paradoxes, things that work great in everyday life. They can actually backfire spectacularly in trading.
Like what? Give me an example.
Okay, here's a big one. Risk. Trading is risky, right? Inherently. You could lose on any given trade.
Yeah.
No guarantees.
Sure.
Now, most people think they accept the risk just by placing a trade. They think, I'm a risk taker. But they don't truly accept it. Deep down, they haven't made peace with the possibility of being wrong or losing.
What does that look like in practice?
Well, the consistently successful traders, our sources say, they can see a trade isn't working out and they exit. Maybe it's a loss, maybe small, maybe break even. And crucially, they do it without the slightest bit of emotional discomfort. It just is what it is. It's part of the game.
Okay.
Whereas the average trader, they get emotionally tangled up. They might freeze or hope it turns around or add to a losing position because letting go feels painful. They haven't accepted the risk up front.
Wow. Yeah, that hits home.
Yeah.
And the sources mention the stat, 95% of trading errors come from just 4 fears.
That's right. Fear of being wrong, fear of losing money, fear of missing out FOMO, and fear of leaving money on the table, like getting out too early.
Now, my first thought is, shouldn't traders have some fear? Isn't a healthy fear of the market just, smart self-preservation?
It seems logical, I know. But in the trading context, fear actually works against you.
How so?
It narrows your perception. You literally don't see information that contradicts your fear. It blocks you from seeing other possibilities, other opportunities. And paradoxically, it often makes you do the thing that leads to the very outcome you're afraid of, like fearing a loss makes you hesitate, miss your exit, and then take a bigger loss.
So the fear itself becomes the problem.
Exactly. It prevents objective perception. The market itself, it's neutral. It's just putting out information. It's our own inappropriate attitudes, our faulty perspectives, as the source material puts it, that cause the mistakes.
It's like our mental software has bugs. Maybe just one bad line of code like I must always be right or using money is terrible, and the whole system crashes when we try to trade.
That's a great analogy. Our minds just aren't naturally wired for this game.
So the big question is, how do you diffuse that? How do you take the threat of pain out of market information when our brains are literally designed to avoid pain?
Yeah, that's the million-dollar question, isn't it? It comes down to understanding perception. Think about it. The market just generates information. Price goes up, price goes down, volume changes, patterns form. That's it. Inherently, that data is neutral.
Okay.
It's our mental framework, our beliefs, our past experiences, especially recent ones, that assigns meaning, that decides if an uptick is good or bad, if a pattern is exciting or scary.
So, like, if I just lost money, the next setup looks terrifying.
Precisely. That's the power of association the sources talk about. Your mind automatically links the now moment with the pain of the recent past. That signal feels way riskier than it might objectively be.
And the opposite, too, right? A few wins, and I feel invincible.
Absolutely. Euphoria kicks in, and suddenly risks seem smaller, or maybe even non-existent. You start breaking your rules.
Yeah.
There's this story in the source material about a client terrified of snakes while his little daughter was just fascinated by them.
Right.
The fear wasn't in the snake itself, it was learned. It was the client's internal association. Same with the market. Most people assume top traders feel the fear but just have nerves of steel to push through it.
Yeah, that's what I would have thought.
But the reality, according to these insights, is that the best traders operate without fear. They've managed to neutralize that association. They don't perceive the market information as threatening in the first place.
Okay, that's a huge shift in perspective. So they've somehow rewired themselves.
In a way, yes. They've changed their core beliefs about the market and about risk.
This explains that perceptual blindness thing too, doesn't it? How sometimes a clear trend is obvious, but only after you've already panicked and gotten out of a losing trade because you were afraid of being wrong.
Exactly. Your fear literally made the opportunity invisible to you in the moment.
So, if trading is this psychologically challenging, why are people drawn to it? What's the real attraction beyond just the money?
That's another paradox. The deep attraction, the sources argue, is the promise of unlimited freedom of creative expression.
Freedom? How so?
In the market, there are no external rules forcing your hand, unlike almost everywhere else in life. Society gives us rules, jobs give us rules, even games have rules.
Right.
But the market, total freedom. You decide when to get in, when to get out, how much to risk. If you follow your plan, it's all on you.
But you said that freedom is also a curse.
It is, because we're not used to it. We crave structure, but the market doesn't provide it. Think about a casino game like blackjack.
Okay.
The rules force you to bet before the hand. There's a clear start and end. Trading doesn't have that built-in structure. You need internal structure, internal discipline, precisely because of the external freedom.
And if you don't have that discipline?
You can become what the sources call a passive loser. You can just sit there in a bad trade, losing more and more money, because nothing forces you to act. The market doesn't care.
Wow.
And here's the kicker. The very freedom that attracts people makes them subconsciously resist creating the internal rules and boundaries they actually need to survive and thrive.
So we have to build our own structure mentally, which brings us to what the sources call the secret, this belief in an uncertain outcome with an edge. Can you unpack that?
Yeah, this is crucial. It's about truly deeply believing two things simultaneously. First, that on any single trade, the outcome is uncertain.
Yeah.
Genuinely, anything can happen.
Anything can happen, okay.
And second, that over a series of trades, if you consistently apply a method with a statistical edge, you'll likely come out ahead.
That sounds like the uncertainty principle you mentioned. Believing anything can happen stops your mind from linking this trade to past wins or losses.
Exactly. It keeps your expectations neutral for the immediate moment. You're not expecting this trade to be a winner or loser based on the last one. You're just executing your edge.
So how does this relate to thinking in probabilities? Is it like how casinos work?
Precisely the analogy the sources use. Casinos profit from random outcomes. Each spin of the roulette wheel is random.
Right.
But they know the overall odds are slightly in their favor. They don't try to predict the next spin. They just keep the wheel spinning, participating in every event where they have their edge, knowing that over thousands of spins, the probabilities guarantee they make money.
Random outcome, consistent results.
That's the paradox. And traders need to adopt that same mindset. This leads to the 5 fundamental truths about trading that form the bedrock of this probabilistic thinking.
Okay, what are they?
1, anything can happen. We covered that. It frees you from needing to predict. 2, you don't need to know what's going to happen next to make money. Your job isn't predicting. It's executing your edge when it appears. 3, there's a random distribution between wins and losses for any given edge. You'll have wins, you'll have losses, and you won't know the sequence in advance.
So you could have 5 losses in a row, even with a good system.
Absolutely. And then 10 wins, or vice versa. It's random in the short term. 4, an edge is just that. An edge, a higher probability of one thing happening over another. It's not a guarantee, just better odds.
Got it.
And 5, every moment in the market is unique. This one's subtle but critical.
Unique, even if a chart pattern looks exactly the same as one from last week.
Yes, because the underlying conditions, the combination of all the traders participating right now with their beliefs and fears, is never exactly the same twice. The context is always unique.
Ah, okay. But our minds are wired to see patterns, to associate. If this looks like last Tuesday,
We automatically assume it will behave like last Tuesday. That's the trap. Our minds are hardwired to associate, as the sources say. We try to know what will happen next based on the past.
and you're saying trying to know is bad for trading.
It's detrimental because it creates rigid expectations. This should happen. And when the unique present moment doesn't conform to your expectation,
Pain, fear, mistakes.
exactly, it triggers the pain avoidance. You deviate from your plan, you miss opportunities, or you hold losers too long. This also sheds light on that boom and bust cycle we see so often. Why do traders figure out how to make money, have a great run, and then lose it all?
Yeah, why does that happen? It's not like they suddenly forget how to analyze the market.
It's usually not about market knowledge. It's psychology. It's either euphoria, getting overconfident, feeling invincible after a string of wins, taking bigger risks, ignoring rules, or it's self-sabotage. Deep-seated conflicts about deserving money, maybe from childhood, maybe guilt, leading them to unconsciously undermine their own success when things get too good.
So the sources basically put traders into three camps.
Yeah, pretty much. You've got your consistent winners, their equity curve, the graph of their account value, generally trends upward with only minor dips, minor drawdowns. Then you have consistent losers. Their curve is basically a mirror image trending down.
Okay.
And then the biggest group, the boom and busters, their equity curve looks like a roller coaster. Big peaks, big valleys.
That makes sense.
And the key insight is the market isn't doing this to you. It's just reflecting your internal your confidence, your fear, your discipline or lack thereof. Blaming the market just keeps you stuck.
So it all comes back to the internal. The goal then is this. Carefree, objective state of mind. Being okay with any outcome, just seeing opportunities flow.
That's the ideal, yes. Being in the zone where you're just executing flawlessly without internal conflict.
How on earth do you get there? It sounds almost zen.
It takes conscious work.
Yeah.
It's about actively aligning your mental environment, or like we said, debugging your mental software. You have to consciously choose to install new beliefs and attitudes.
Okay, how do you install new beliefs?
The sources emphasize what they call the mechanical stage. This is where you deliberately practice executing a specific trading system with a defined edge over and over, focusing only on perfect execution, not the outcome of each trade.
Like building muscle memory, but for your mind.
Exactly. The goal of this stage isn't necessarily to make money right away, but to build crucial psychological skills. Self-trust in an unstructured environment, flawless execution, learning to think in probabilities naturally, and developing an unshakable belief in your own consistency.
And this builds on those 7 principles of consistency.
Precisely. Those principles are the framework for that mechanical practice. Let's recap them quickly because they're vital.
Okay.
1, objectively identify your edges. Know exactly what your setup looks like. No fuzziness. 2, predefine the risk on every trade. Know your stop-loss point before you enter.
Critical.
3, completely accept that risk. Be genuinely okay with losing that predefined amount. If you're not, the risk is too big for you psychologically. 4, act on your edges without reservation or hesitation. See the signal, take the trade. No second guessing. 5, pay yourself as the market makes money available. Have a plan for taking profits systematically. Don't let greed sabotage you.
Okay.
6, continually monitor your susceptibility to errors. Be self-aware. Are you feeling fearful, greedy, overconfident? Catch it early. And 7, understand these principles are absolutely necessary. Never violate them. They are your non-negotiable rules of engagement.
So you practice these relentlessly.
Yes. And the underlying belief you're trying to instill, the core affirmation is, I am a consistently successful trader.
And self-discipline is the key to making that belief stick.
Self-discipline is the tool you use to consciously shift your mental energy away from the old conflicting beliefs, like I might fail or it's hard to make money, towards the new desired belief, I am consistent. It means becoming an objective observer of your own thoughts and actions during trading without judging yourself, just noticing, there's that fear again, or oops, I hesitated, and then gently redirecting back to your rules.
That Grand Canyon Bridge analogy comes to mind here.
Yeah, that's a powerful one. Your position size is the width of the bridge you're walking across. For someone trading huge positions, like a bond trader with thousands of contracts, That bridge is like a tightrope.
Right.
Even one distracting thought, a flicker of doubt, a moment of greed, a jolt of fear can cause a slight wobble, a hesitation, maybe missing an exit by a split second, and the consequences can be disastrous with that kind of leverage.
So managing the thoughts becomes paramount.
Absolutely. Which is why focusing on trading in sample sizes is so important. Don't get emotionally invested in any single trade outcome. Think in terms of the next 20 trades or 30 trades.
Let the statistics work.
Exactly. Allow your edge to play out over that larger sample, just like the casino relies on thousands of spins, not just one. This detaches you emotionally from the noise of individual wins and losses.
So wrapping this up, consistency isn't about predicting the market better. It's about mastering yourself, being rigid in your rules, flexible in your expectations.
Beautifully put. That's
Yeah.
the essence of it.
And the payoff is, when you get there, when you truly embody these principles and beliefs, the struggle disappears. It becomes easy.
Effortless is the word the sources often use. Not that you don't put in effort to follow your plan, but the internal conflict is gone. It feels natural. You don't have to try so hard to be consistent anymore. You just are.
So the big takeaway here is this shift. Stop looking for the holy grail in market analysis and start looking inward at your own mental landscape. Trading success is really a journey of personal growth, isn't it? You have to sort of grow into the person who can trade successfully.
That's a perfect way to frame it. It's a path of self-discovery and self-mastery reflected in your trading account. So maybe a final thought for everyone listening. If the market truly acts as a mirror, reflecting what's inside you, what will your reflection show about your current beliefs, your fears, your attitudes the next time you step up to look for an opportunity?
Something to think about.
Keep observing yourself. Keep working on those principles. It's a continuous process.
That's it for today's breakdown of Trading in the Zone by Mark Douglas. If you found this helpful, make sure to subscribe so you don't miss the next upload. And if you'd like to connect, all my social links are in the About section of the channel. This is Library Trader by Option Arcade. Trade smart, stay disciplined, and I'll see you in the next one.